Good day, friends. In this video, I want to talk about the basic principles of choosing an option strategy, specifically for position trading, a trade where you don't need to actively manage risk, like for example volatility trading, where delta hedging and rolling are used. But first, I would like to remind you, this question has been coming to us a lot lately. If your toolboard window is empty and you don't know what to do, you open the main toolbar and find there the value Tools, click on it, and now the tools have opened. If this window is empty, it is easy to add tools. You need the icon on the right side of the menu, Selector. The Tool Selector window has opened. Here you can click on the AE, then Futures, and select all the names you need. Then drag them to the Tools window with the left mouse button. You can select what you need and drag it. You can do the same with the Equity tab, if you want their information displayed too. And now your Tools window is full. Here you can enable sorting of the list, and by clicking on the three dots, you will see Show Market Depth, Volatility Chart, Stock Chart, and Open Option Board. You can see the same options by right-clicking. So by opening the option board and clicking on the View Chart button, we can see our strategy chart. If you want to clear your option board, you need this button on the right. Okay, let's get back to the topic of our video. How to choose an option strategy by focusing on the market and your expectations. If you see that Bitcoin has fallen into a channel and is not changing much, and you think it will stay there, then an option selling strategy will come in handy. For example, Strangle. I sell call options at strike 30,500 and put options at strike 29. I click the View Chart button and get the sold Strangle. If we expect the price to stay inside a certain range, we should choose the Strangle. To protect our options if any of them go in the money, I recommend using delta hedging. The robots are in the bots section of the web terminal and desktop terminal. If you believe that Bitcoin price will not fall much, you expect it not fall below 29,000, in this case you can sell put options. The volatility level of Bitcoin options is low right now, hence the ratio spread has no credit. If selling simple options doesn't work, at least you will get Bitcoin at a low price. And if we didn't expect the price to rise significantly, we can sell call options. For example, we don't expect the price to go above 31k before expiration. Always pay attention to the expiration date you have chosen for your option series. If the price rises, we will receive short of the Bitcoin futures. We can also consider trending scenarios. Before we looked at counter-trending strategies, because we do not expect price movements. In trending strategies, we do expect price movements. If we are expecting price to rise, the best strategy in this case is a vertical spread. Let's say the price goes above 31,000. In this case, we buy call options of strike 30,500 and sell options at strike 31. This is what our strategy looks like. In a vertical spread, we have a loss limit, which is the premium of the strategy, and take profit. I have dedicated a whole lesson to vertical spreads. Let me remind you that vertical spreads can be used for a scenario where you don't expect the price to fall much. We sell put options, 28,500. In this case, we will have a limited maximum loss. You may find this strategy useful, but only if you use delta hedging. Here, the potential risk is higher than the potential profit. With delta hedging, you neutralize the delta. Let me demonstrate this for you. Minus 100 futures. The price is 29,500. In this case, our chart will tilt a bit. Let me remind you that sold vertical spreads have lower margin requirements, and this is their advantage. If we expect a significant price movement, but we do not know in which direction, there is a rule. The longer the price is in a narrow range, the stronger will be the exit from this channel. In this case, we can use the strategy Inverted Iron Condor. We buy call options of strike 30,500, put options at strike 29,000, and we get a strangle. After that, we sell the neighboring options. Call options 31,000, put options 28,500. Thus, we get an inverted iron condor. The idea is that a significant move will happen, and we will be on the wing of the condor. You can also use a butterfly. For example, a call butterfly. The futures price is at 30k for so long. Hence, this is the number we choose. We sell neighboring strikes. In this case, I bought 2,000 options of strike 30,000 and another 1,000 at strike 30,500. Thus, I get a short inverted butterfly. For such case, it is better to choose the nearest expiration date. There are more complicated butterfly options. You can make it with different wings, using different number of options. And I'll be honest, I'm not a big fan of buying just simple options. It's expensive and rarely results in a profit. It takes a very strong price movement to compensate for such purchase. You can catch the moment, but you can't use buying of simple options to make money all the time. When using a butterfly, be careful not to get into the strike pit, the zone of purchased options. Options trading is smart trading that allows you to make money on any market condition, even if it's standing still or moving. Learn options. Ask questions in the comments, I will try to answer them all. Subscribe to the channel if you haven't already done so. I wish you all the best and successful options trading.